Hello, and as was just stated, I'm Kalila Imperatrice from Division of Registration and Inspections, and I'm here to walk you through the broker-dealer firm program update. Okay. Clearly have, oh, there we go. Okay, and at the end of this session, participants will be able to understand the content of the recently issued 4020T annual report and supplemental information documents, discuss some of the findings from the 2021 broker-dealer firm PCAOB inspections, and understand the status of our 2022 broker-dealer firm inspection activities. Our latest report is the 11th annual for the program and was issued on August 19th of this year, and it covers the 2021 inspections activities. The PCAOB's oversight authority of broker-dealers, of auditors of broker-dealers, came with the passage of the Dodd-Frank Act in 2010, which followed the discovery of the Bernie Madoff scandal. In 2011, the PCAOB enacted Rule 4020T to establish the interim inspection program, and we began performing inspections under that program in that year. This report is an aggregate report covering all inspections for our most recent inspection year. It provides a look at our inspection activities and results over time. Unlike our issuer inspection program, we have not issued firm-specific reports for our broker-dealer inspection activities. We also have not identified the public accounting firms or the broker-dealer whose engagements we reviewed in their and we also don't have non-public portions of the report, unlike the firm inspection reports from the issuer program. We organize our findings around 4 categories of assurance that auditors provide to broker-dealers, which are the audit opinion on the basic financials, the audit on supplemental information, examination reports, and review reports. The annual report also includes quality control deficiencies, which are firm, not engagement level deficiencies. Throughout the annual report, we highlight good practices and recommended actions we believe may help firms prevent audit and attestation deficiencies from reoccurring. During this presentation, we will discuss some of the good practices and recommended actions. Beginning with last year's report, we separated the analysis of our program results over time into a supplementary information document. Because we have accumulated so much data in the history of our program, we believe splitting those historical results into a separate document would make them easier to read. The supplement also includes an analysis of our program results over time and stratified using various characteristics. So now it's time for our first polling question. Which type of engagement experienced an increase in the percentage of engagements with deficiencies in 2021 compared to 2020? A, audit engagements, B, examination engagements, C, review engagements, and D, agreed upon procedure engagements. I'll give you time to cast your votes. And, well, it looks like most of you did not get this right. It would be C, review engagements. We will present our results for the audit, examination, and review engagements on the next slide. Agreed upon procedure engagements such as SIPC, fee, AUP engagements are not subject to PCAOB inspections. This slide provides a summary of results at an engagement level for the last 3 inspection years. So what are some of the key takeaways? As you can see in the bold rows, the number and composition of our selections changed from 2021 in recent years. In 2021, we selected a greater number of engagements for broker-dealers that filed compliance reports than in prior years. This was in response to the heightened risk associated with the potential changes in control procedures during the COVID-19 pandemic for broker-dealers that have responsibility for custody and control of customer funds and securities. These broker-dealers file compliance reports and are generally larger and more complex than broker-dealers that file exemption reports. This necessitated a greater allocation of PCAOB resources in 2021. Consequently, we selected fewer examination report filers, resulting in fewer selections overall in 2021 compared to 2020 and prior years. Regarding our results by type of engagement, the percentage of audit engagements where we identified deficiencies declined to 49% in 2021 from 61% in 2020, but remained high primarily due to deficiencies associated with auditing revenue. The percentage of examination engagements where we identified one or more deficiencies declined slightly to 64% of engagements in 2021 from 67% in 2020, but remained high primarily due to deficiencies testing internal controls over compliance, also known as ICOC. The percentage of review engagements where we identified most deficiencies increased to 28% in 2021 from 23% in 2020. We found no apparent violations of SEC independence rule in 2021. This is the first year in our program's history with no such findings. Now let's discuss our examination engagement results. The majority of identified examination engagement deficiencies related to testing the design and operating effectiveness of ICOC with broker-dealer financial responsibility rules. The level of deficiencies overall were comparable to prior year and remained high. ICOC concerns with a series of financial responsibility rules applicable to broker-dealers that file compliance report. These include the net capital rule, the customer protection rule, the quarterly security counts rule, and the account statement rule. The financial responsibility rules help protect customers of broker-dealers. For example, by ensuring adequate funds are held in reserves to cover balances the broker-dealers owe to their customers, or that information provided to customers in their account statement is complete and accurate. The majority of the 64% of deficiency relates to engagement teams that either did not test or did not sufficiently test one or more important controls related to the compliance of these rules. Some of our issues involving testing controls with a review element, IT general controls, and/or automated application controls. Now it's time for a CPE check-in. The code is 135. The majority of identified deficiencies in examination engagements relate to testing of controls over compliance with financial responsibility rules. We recommend firms improve their testing in these important controls in 3 areas. 1, controls over the accuracy and completeness of information produced by the broker-dealer, upon which the design and operating effectiveness of ICOC are dependent. 2, controls with a review element, and 3, information technology controls. Training and increased involvement of more experienced team members on examination engagements may be helpful. A particular concern are firms that did not test the design and operating effectiveness of any internal controls over compliance with one or more financial responsibility rules. We recommend such firms on the determination of important controls and related testing strategies for each financial responsibility rule during the examination engagement planning. On the next few slides, I'm going to walk you through a few scenarios. In our first scenario, we will cover information technology controls. A broker-dealer used an internally developed application to support its business operations, including recording of customer security transactions. The application was used in the broker-dealer's ICOC with the financial responsibility rules. The auditor determined that information technology controls over the application to be important to the auditor's conclusion about whether the broker-dealer maintained effective ICOC with the financial responsibility rules. Now, which of the following is true under this scenario? A, only IT controls associated with program development and program changes need to be assessed for relevance in addressing risk associated with the financial responsibility rules. B, the auditor should test both the design and operating effectiveness of important IT controls. C, the auditor should test the controls only as of the broker-dealer's fiscal year end. And D, automated application controls would generally be expected to be a higher risk if the important IT controls are effective. And the correct answer is B, which looks like everyone got right. Auditors should test the design and operating effectiveness of important IT controls. Response A is not correct because in addition to controls associated with program development and program changes, auditors should also consider whether controls over access to programs and data and controls over computer operations are relevant to addressing risk related to the financial responsibility rules. Response C is not correct because important controls should be tested throughout the period and at the fiscal year end. Response D is not correct as AT1 paragraph 13 states that factors that affect the associated risk with a control include whether the control is automated, i.e. an automated control would generally be expected to be lower risk if the IT general controls are effective. In this next scenario, we will be covering the customer reserve computation. The auditor considered management's weekly reserve computation review control to be an important control for addressing compliance with the reserve requirements rule. The auditor determined that the control owner used reports prepared by the broker-dealer as part of the review. Which of the following is true in this scenario? A, inquiries of the control owner should not include inquiries regarding criteria used to identify and correct errors. B, controls over the accuracy and completeness of the reports used by control owners are not important controls. C, a combination of reperformance and inspection procedures could provide sufficient appropriate evidence regarding the operating effectiveness of management's weekly reserve computation review. Or D, evidence obtained through the testing of the reserve computation review control is relevant to auditors' objectives in testing the customer reserve computation under AS 2101. Oops. I think I went too far. Is it this one? Is this the one? Yes. Okay. Go ahead. All right. The correct answer is C. Reperformance and inspection procedures can be effective procedures to test control with a review element. Reperformance could entail tracing the credit and debit balances included in the customer reserve computation selected for testing to their source reports and determining that the credit and debit balances included were determined in accordance with the reserve requirements rule. Inspection could entail review of documentation used by the control owner to perform the review and review of the control owner's documentation of the review, which may include sign-off. Response A is not correct, as inquiries to understand the nature of the controls with a review element should include these aspects along with other aspects such as the nature of the review and information used during the review. Response B is not correct, as controls over the accuracy and completeness of reports used by the control owner may be important controls, depending on the risk associated with the information included in the reports. Such controls could be other management review type controls, automated application controls in the system or systems that produce the reports, or possibly the control owner's review itself. Response D is not correct, as AS 2701 paragraph 3 states that the nature, timing, and extent of audit procedures necessary to obtain sufficient appropriate audit evidence to report on the supplemental information depends on, among other things, the evidence obtained from the audit of the financial statements and other engagements by the auditor. The auditor should take into account relevant evidence from the audit of the financial statements and the audit of the broker-dealers, the attestation engagements, in planning and performing audit procedures related to the supplemental information. Now let's discuss our review engagement results. The majority of the identified review engagement deficiencies involve engagement teams that obtained audit evidence that contradicted assertions that the broker-dealers made in their exemption reports regarding compliance with the exemption provision claimed. As you know, an exemption is based upon the broker-dealer asserts that it is not required to comply with the customer protection rule. And there are a variety of reasons why that might be the case, depending on the nature of the broker-dealer's operations. AT number 2 requires that the auditor take into account evidence obtained through the audit when performing the review engagement. And there are times when audit evidence appears to contradict what the broker-dealer is saying in its exemption report. A common example is a broker-dealer that asserts in its exemption report that all the customer-related business is conducted through a clearing broker via the claim of exemption under paragraph K2II. However, the auditor has evidence that the broker-dealer does not maintain a relationship with the clearing broker, and the auditor did not resolve that inconsistency during the review engagement. Or take a broker-dealer that claims an exemption under paragraph K2II that does introduce customers' security transactions to a clearing broker. However, the broker-dealer engages in other customer securities business conducted outside of that arrangement with the clearing broker. In those circumstances, we expect auditors to evaluate whether and how the other customer security businesses are covered under the broker-dealer's assertion in its exemption report, including the proper disclosure and any exceptions. In recent years, we have observed through our inspections an increase in the broker-dealers that assert the basis for exemption other than those contemplated by paragraph K of the Customer Protection Rule. For example, claims of exemption based on footnote 74 in the adopting release of the July 30th, 2013 amendments to Rule 17A5, or based on the SEC staff guidance in the form of frequently asked questions. PCAOB inspectors are aware of and consider these other sources of guidance when conducting our inspections of review engagements. And we encourage auditors of broker-dealers to also consider this guidance when performing a review engagements. The most frequently cited deficiency in review engagement involves firms that did not take into account evidence obtained during the audit that contradicted the broker-dealer's assertions in a review report regarding compliance with the exemption provision claimed, which I mentioned earlier. This is particularly true for broker-dealers that only claimed exemption under paragraph K2II of the Customer Protection Rule and that conduct customer securities transactions outside of arrangements with the clearing broker. For these broker-dealers, we recommend that the engagement team members discuss evidence obtained through the audit regarding the nature of the broker-dealer's operations and its products and services, and how that evidence relates to the assertions made by the broker-dealer in review reports. Which financial statement area are the most frequently cited deficiencies? A, revenue, B, receivables and payables, C, related party transactions, D, fair value measurements. And everyone got this right, almost everyone got this right. The correct answer is A, revenue. However, these responses are the 4 most frequently reviewed financial statement focus areas that had deficiencies. So I'm going to walk you through the top 6 financial statement areas with deficiencies from our 2021 inspections, including the 4 that we just went over. You can see the relative frequency for which we included these areas in scope out of the 92 audits reviewed. As I mentioned earlier, revenue is the most frequently cited deficiency area. Many of the deficiencies in this focus area are grounded in the requirements of AS 2301 to address assessed risk of material misstatement at an assertion level, including not performing appropriate test of details in areas assessed to be significant risk. On the substantive procedure side, we also identified deficiencies in audit sampling under AS 2315 and testing the accuracy and completeness of information produced by the broker-dealer and used as evidence under AS 1105, and in applying the requirements of substantive analytical procedures under AS 2305. On the control side, we identified various deficiencies regarding reliance on controls at the service organization under AS 2601, and reliance on controls that are not tested when determining substantive sample sizes under AS 2301 and AS 2315. Beyond those deficiencies, other deficiencies related to the risk assessment requirements of AS 2110 and the requirements to test disclosure under AS 2810 also relate to revenue but are separately presented in the 4020T report. While revenue continues to drive an overall high rate of audit engagement with deficiencies, we have seen improvement in the last 2 years as indicated in the chart. The next area is related party transactions, which are prevalent in broker-dealers, often due to the fact that a broker-dealer may be part of a larger, complex financial institution with business conducted between and amongst affiliates. Shared service or expense sharing agreements and management service agreements are common in the broker-dealer industry. Other broker-dealers are controlled by one or a few key persons who may have outside business interests as well. We commonly encounter broker-dealers with material disclosed related party transactions or organizational structures or relationships that suggest material related party transactions may exist but are not disclosed. Deficiencies in this area are generally grounded in AS 2401 and include engagement teams that did not test material related party transactions or teams that did not identify omitted or inaccurate disclosures regarding related party transactions. Many broker-dealers are structured to operate at or near break-even and are thinly capitalized. Some of these broker-dealers are dependent upon the support of parents and affiliates to continue to operate to meet their net capital requirements. In those cases, we may scope in going concern as an area. Deficiencies here are primarily grounded in AS 2415 and relate to engagement teams that did not obtain sufficient evidence about the intent and ability of other parties to provide support to the broker-dealer, as well as disclosure and reporting issues. The next area is expense and related accruals, was one of the most frequently inspected non-traditional focus areas along with cash. You can see it was not selected for review in the previous 2 years. Another area is fair value measurements. One question you may be asking is whether fair value measurements results were attributable to the implementation of AS 2501 versus the rescinded AS 2502, and that was not the case. And finally, on receivables and payables, I want to point out that this focus area is mainly about customer balances at broker-dealers. It is more akin to a loan and deposits at a bank than trade receivables. You can see we have had some improvement in this area in recent years. It's time for another CPE check-in, 8:50, and I'll also see if there's any questions that have come in. No questions so far? Deficiencies related to revenue comprise over half of the audit deficiencies identified in 2021 and include deficiencies throughout the audit process, including risk assessment, responding to risk, and evaluating audit results. Firms should enhance their understanding of the broker-dealer's internal control over financial reporting, including information systems and related business processes, and their understanding of control activities, including controls that are intended to address fraud risk. Firms should also design audit procedures to address the assessed risk of material misstatement at an assertion level, including tests of details that are specifically responsive to risk of improper revenue recognition due to fraud when identified. In addition, firms must evaluate whether the broker-dealer's financial statements are presented fairly in all material aspects, including whether the broker-dealer's revenue recognition and related disclosures comply with the requirements of FASB ASC Topic 606, Revenue of Contracts with Customers. So here's a revenue scenario. A broker-dealer earned fees from a private placement securities. The auditor took a substantive approach that included tested details to address an identified fraud risk related to improper revenue recognition. Which of the following is true under this scenario? A, because the auditor's approach is substantive, no evaluation of controls is required. B, substantive analytical procedures rather than tested details could be sufficient to respond to the identified fraud risk. C, if the auditor's approach includes audit sampling, all items in the population should have had the opportunity to be selected. And D, evidence that private placement transactions closed provides evidence related to the completeness assertion. All right, it looks like we got this right too. The correct answer is C. AS 2315, paragraph 24 states that all items in the population should have an opportunity to be selected. Response A is incorrect because AS 2110, paragraph 73 states that when an auditor has determined that a significant risk, including a fraud risk, exists, the auditor should evaluate the design of the company's controls that are intended to address fraud risk and other significant risks and determine whether those controls have been implemented. Response B is incorrect because AS 2301, paragraph 11 states that the significant risk, the auditor should perform substantive procedures, including tested details that are specifically responsive to the assessed risk. Response D is incorrect because evidence that a transaction closed, i.e. occurred, provides evidence related to the occurrence assertion. The next scenario is on fair value measurements. A broker-dealer held a portfolio of equity and debt securities measured at fair value. The broker-dealer measured its equity securities based on the prices quoted on an exchange or debt securities based on inputs other than quoted prices that were observable either directly or indirectly. The broker-dealer obtained the pricing information for both equity and debt securities from third-party pricing service A. The auditor chose to test the broker-dealer's estimated fair value of equity and debt securities by developing an independent expectation for fair value used information from third-party pricing service B. So which under this scenario are true? A, because the auditor is developing an independent expectation of fair value, the auditor does not need to understand the broker-dealer's process for developing the fair value estimate. B, the auditor should understand the nature of any relationship that the broker-dealer might have with pricing service B. C, the auditor's responsibilities are the same whether pricing service B used identical or comparable securities to price the debt securities. And D, because the auditor chose to develop an independent expectation, it should not also use other methods described in AS 2501. All right, looks like we're trending to the correct answer here as well. The correct answer is B, because the relationship can affect the reliability of the pricing information used by the pricing service. Response A is incorrect, as the auditor should obtain an understanding of the broker-dealer's process so that the auditor's expectation considers the relevant factors to the estimate. Response C is incorrect. In general, fair values of financial instruments based on trades of identical financial instruments in an active market have a lower risk of a material misstatement than fair values derived from observable trades of similar financial instruments or unobservable inputs. Therefore, the auditor will need to perform additional audit procedures over the pricing service that uses comparable securities. Response D is incorrect because the auditor can test an accounting estimate using one or a combination of approaches, which include 1, testing the broker-dealer's process used to develop the accounting estimate, 2, develop an independent expectation, and 3, evaluate audit evidence from events or transactions occurring after the measurement date related to the accounting estimate for the comparison with the broker-dealer's estimate. Earlier, I mentioned the required supplemental information that broker-dealers must include in their annual financial reports. Such information is required by the Customer Protection Rule and the Net Capital Rule, 2 of the financial responsibility rules that I mentioned earlier. The Customer Protection Rule requires the presentation of a customer reserve schedule and a possession or control schedule in the broker-dealer's financial report. The Net Capital Rule requires presentation of the net capital schedule. The applicable auditing standard for the PCAOB is AS 2701. Generally, these deficiencies fall into 2 broad categories. 1, insufficient procedures to test the completeness and accuracy of the information presented in the schedules, or supporting information produced by the broker-dealers and used to prepare the schedules. And 2, insufficient procedures to evaluate whether the amounts presented in the schedule were determined in compliance with the applicable rule. We will go over a few specific deficiencies related to compliance with the following rules. For the customer reserve requirements of the Customer Protection Rule, we identified instances where engagement teams did not evaluate whether an account qualified as a special reserve account, a special reserve bank account, given the language in the bank's notification letter that permitted the bank to impose charges on the account. For the possession or control requirements for the Customer Protection Rule, we identified instances where engagement teams did not assess whether the excess margin calculations were properly taken into account for each customer account under common ownership. For the Net Capital Rule, we identified where engagement teams did not assess the allowability of certain assets, including deposits with clearing broker-dealers and commissions receivable. Time for another CPE check-in. Code is 336. The quality control deficiencies are broken out by the following categories: engagement performance, personnel management, monitoring, independence, integrity, and objectivity. As you can see on the slide, the majority of deficiencies relate to engagement performance. A significant portion of the engagement performance deficiencies relate to the engagement quality review. Engagement quality reviewers did not identify certain areas or certain required disclosures omitted from broker-dealer financial statements, documents containing broker-dealer management assertions, and engagement reports. In addition, other firms did not perform engagement quality reviews for the broker-dealer audit and attestation engagements. Engagement quality reviews at many firms were not performed with due professional care in accordance with AS 1220. Other firms did not perform engagement quality reviews at all. Firms should ensure that their policies and procedures cover all aspects of each engagement, including engagement quality reviews pursuant to AS 1220. We recommend that firms' policies and procedure address compliance with AS 1220 for broker-dealer engagements, including how the firm ensures that engagement quality reviewers meet the requirements of AS 1220. Some firms may consider appointment of individuals outside of the firm as engagement quality reviewers when necessary to meet the qualification requirements. As I mentioned earlier, we published a second document to accompany the 4020T report. This supplementary document provides information about our selected firms and engagement over time and stratified based on firm inspection and broker-dealer characteristics. The characteristics included in this report are a subset of the characteristics we study each year as part of our reporting process. but represent the characteristics that we believe are particularly noteworthy. Here are some interesting statistics about our selections since the adoption of the interim program that can be found in the supplementary information. We have completed 657 firm inspections of 403 individual firms. Those inspections covered 1,038 audits, 759 of which were required to be performed in accordance with PCAOB standards. These inspections also covered 187 examination engagements and 564 review engagements. Our stratification of results by various characteristics over time suggests the following. Firms that audit broker-dealer that filed compliance reports tend to have a lower deficiency rate compared to those that only audit broker-dealers of exemption reports. Firms that also audit issuers tend to have a lower deficiency rate compared to those that do not. Firms that audit more broker-dealers tend to have less deficiencies. Inspection frequency also matters. The firms that have been inspected every year, which includes the Big Four, have generally performed better over time. Other firms that have been inspected more than once have generally performed better as a group with each incremental inspection. Audits of broker-dealers that file compliance reports have fewer focus areas with deficiencies when compared to audits of broker-dealers that file exemption reports, irrespective of the firm performing the audit, which would be 22% versus 28% over the PCAOB standards period. Now I'd like to spend a moment just to discuss our 2022 inspections. Generally, we expect to inspect a similar number of firms and review a similar number of audits in 2022 as we did in 2021. We continue to have an increased focus on compliance report filers compared to the prior years. As was the case in 2021, for 2022, we selected a portion of broker-dealer audits on a random basis as well as on a risk basis, and we continue to select non-traditional focus areas to review. Fieldwork for our 2022 inspections began in March and will continue through December. The significant majority of our inspections, again, have been conducted remotely, like in the last 2 years. However, beginning in late summer, we resumed in-person inspections on a limited basis and hope to be able to resume more in-person inspections as we look ahead to 2023. Time for another CPE check-in. The code is 289. So thank you for listening to this session of the Small Business and Broker-Dealer Forum today. I'll just let you know that most of what I covered today is covered in the 4020T annual report and supplemental information documents that are out on our website. Now, at this time, I will take a look at what questions that have come in. Okay. A lot of the revenue deficiencies also related to disclosure errors, such as not disclosures of disaggregated revenues. Issues specific to revenue disclosures are included in the 4020T. They are classified in the evaluating audit results section, which addresses deficiencies under AS 2810. The next question is, if an engagement team deemed an account or class of transactions a significant risk, would it be expected that inherent risk would be high risk, or would moderate risk be acceptable? Now, under PCAOB, the standards do not define a continuum along which inherent risk should be assessed. Inherent risk assessment is a course of auditor judgment. The factors that lead to determination of significant risk would likely be relevant to consider assessing inherent risk in an account or at assertion level. The next question is, how do you reconcile your inspections with no firms are auditing broker-dealers appropriate with the lack of failures? There have been many inspections of firms in 2021 that did not have deficiencies identified by the PCAOB. certain deficiencies might have a higher correlation to the potential for a broker-dealer failure than others. For example, going concern deficiencies or deficiencies in testing broker-dealers' net capital compliance. We identify and communicate all PCAOB standard deficiencies identified through our inspections. I think that was the last question, so thank you. Kent.